Thanks for handoff, and thanks everyone for being here this afternoon. My name is Kevin Abrams. I'm a consulting actuary here with Affinity, as Leah said at the top, along with Dave and with Don. And not surprisingly, a lot of the information that covers these plans overlaps. So basically what my session is going to cover is just kind of making sure you've been paying attention, because there's a lot of overlap with what Dave shared and what Don shared. So forgive me if I've repeated anything, but these are obviously important facts. So let me go ahead and pull up mine. Let's see. Share that. All right. So what I'm going to talk about is generally from day one, we want to sign up this pension plan until the end. Don just spoke before me and he covered a lot of those bases. So again, there may be some repetition here, but these are obviously very important concepts that we want to be aware of from the beginning of the plan's life until the very end, when we're ready to shut down and pay everybody out. So example number one, this is a slide that Don just showed a few minutes ago, just who is a good candidate for sponsoring a defined benefit cash balance plan. And right now I say defined benefit cash balance. I'll delineate between the two in just a few minutes. So obviously the ideal candidate is someone that has a successful business. They have a steady, predictable income from year to year, kind of like what Don said a few minutes ago. It's not necessarily just a big windfall in 1 year. And if you're an attorney and you win a big case and you have this big influx of cash, we can make those work. And obviously there's always depends when it comes to these types of plans, but generally we're looking for something that is a multi-year commitment, and generally you have the income to be able to support that. And the bottom part right there, as Dave kind of pointed out in his session, we definitely cater to all types of plans. There's the plans that we have where just the sole proprietor, it's a single owner, or as a spouse, owner and spouse, 2 business partners, and then majority of the plans that we have an employee, have 5 employees, have 10 employees. And we can still design these plans to be lucrative for the plan sponsor, who's of course in charge of the plan. But of course there's discrimination requirements that Dave went through that we have to account for, usually combining the cash balance plan with the defined contribution plan. So I'll start real quick, and this should be a basic example, but in this example, I'm going to just compare the difference between the possibilities of a defined contribution plan versus what someone can get in a defined benefit plan. So Dr. Smith is my example. She's age 50, and this year she's pulling down $290,000 in W-2. No employees wanting to worry about that for this conversation. So her options are do nothing, no retirement plan at all, no savings, and no tax deduction. So, excuse me, that's probably not the ideal way to go long-term thinking. So she can add this defined contribution plan that I've shown here, and I won't do another slide with all the limits because that Dave and Don already showed, but the maximum annual addition in a defined contribution plan is obviously limited. And as you can see here, assuming that based on the fact that she's age 50, so she can put in this catch-up contribution that many of you are probably familiar with, the most that she can put in for 2021 on behalf of herself and as the practice on her behalf is $64,500. And so between the contributions that she's putting in from her own W-2 and the contributions funded on her behalf from the company, that's approximately 22% of her W-2 compensation. Certainly a great tax savings, certainly great retirement savings. But of course, the question is always, is there more? And that's where we want to talk about a defined benefit plan. So in a defined benefit plan, let's look at the same situation. Dr. Smith here, the same age 50. And while the Internal Revenue Code limits a defined contribution plan, you look at the page and it says this is the most that someone can put in for a year, whether they're 10 years old or 90 years old, or to an extent. Okay, sorry. In a defined benefit plan, it's all dependent upon ages. So a 50-year-old can potentially have a much higher contribution to the plan, as you can see here. I think Don quoted a 50-year-old, the maximum lump sum that they could put into a DB plan for the first year around 158, I think you said. So there's a little gray area because there's all these underlying variables, but basically we can look at the fact that if compared a defined contribution plan to a defined benefit plan in this one particular year, additional savings of almost more than double what you can get in the 401k defined contribution plan. And as things progress over year, Dr. Smith would be able to potentially put in that same amount, $162,000 per year, as we continue on. So it's not just a one-time blip. And as you can see, the hypothetical contribution that she could technically put in is over half of her W-2 compensation compared to under a quarter. So just to summarize here, the defined benefit plan obviously is the main theme here, that it affords her a higher deduction, which is important on the near term, and it allows her to put away more for retirement income down the road. So, and hold your laughter, please, but the fundamentals, and I put fund in quotes because obviously we're talking about funding here. I'm just going to go over a few baseline things. Some of them have already been covered already, but obviously this, like all qualified plans, like a 401k plan, the minute you already have, this plan is established by the employer. They're the sponsor, they're the fiduciary. They generally make all the decisions for how the plan is designed and set up, along with us and the different parties involved. Generally, all the plans that we have are, the contributions come from the employer. There are defined benefit plans that are out there somewhere. They're generally, in prior decades, they were more popular that require employee contributions, similar to like a 401k plan. We don't administer any of those. And for the rest of this presentation, I'll just go on the basis that every contribution is funded on behalf of the employees from the employer. And again, not to belabor the point, but the last three items kind of tie together where it just says, this is a defined benefit plan. In a profit sharing type plan, you're the employer, you give your employee $1,000 as a contribution. They have it in their individual account, and it grows as they allocate their investments. And if it grows or if it drops, in so many words that, that's a tough situation, but the requirement is not on the sponsor to make up for any losses. In a defined benefit plan, as the name implies, the benefits are defined. So that when you look at a plan document, it doesn't say, oh, in any given year, John Smith can have a benefit of whatever I say it is, or depending on my profits this year, John Smith is owed a benefit of $100 per month for the rest of his life, or whatever the formula is in the plan. So basically, the plan is defined as the name implies. So there's different options, and Dave kind of spoke on this a little bit. So, the typical defined benefit plan says this employee comes work for me. When they retire, they'll get $100. This is just an example, a simple example, but $100 per month from the day they retire at age 62 for the rest of their life. Well, in our world, in the small market world, the annuity is a lot less prevalent. And so a lot of the times, instead of saying, okay, employee, that you've just left me, you've just left our company, and here you have this promise of a benefit for a monthly benefit for the rest of your life in 12 years. In this example, a 50-year-old that will start to take her annuity payments at age 62. Well, a lot of times they'll say, well, what is the value of that today? That's a more tangible number. What is the lump sum present value of this? Meaning, that payment stream that's supposed to start at age 62 for me until for the duration of my life, they're using mortality and interest rate assumptions that are just some boring, behind the scenes actuarial stuff. We can calculate, well, what is the value of that today for that 50-year-old? We can say, well, we expect you to take 12 payments a year of $100 for however long a 62-year-old is expected to live. Well, what is that today? And age 50 for 12 years before that in a lump sum value. And in our market, almost 100% of the time, the interested party cares more about the lump sum value of what is my money today, rather than what I'm going to get 12 years from now on a monthly basis. And so that's the actual equivalent lump sum. So like I said, most parties, whether it's the participant reading their annual statements, or the plan sponsors that are thinking about what their contribution is going to look like, or the advisors that are on the case that are working to grow the investments over the course of the plan, for all intents and purposes, we generally view this benefit as a lump sum rather than an annuity, because that's generally how they get paid. So even though the foundation of a defined benefit plan is an annuity, as we've talked about throughout this afternoon, it might be a little easier to tailor this plan such that the defined benefit is actually in the form of a lump sum, which is a little bit more English. It's similar in ways to a profit sharing 401k type plan. I think that Don noted. Obviously, there's plenty of differences, which is why they're a type of defined benefit plan. But cash balance plans have become more of the norm rather than your traditional annuity benefit plans. And that's partially because they are a lot easier to set up, to administer, to understand what's going on from year to year. So how does it work? Rather than defining that monthly annuity down the road that someone could take out, we basically just say, we write into the plan document that each employee, there could be several different groups. There could be an owner group, there could be a spouse group, there could be an excluded group. There's a formula that applies to each participant that says they get a contribution credit applied each year. That has nothing to do with any investments. That's based on how the plan is originally designed. And usually when we have these cases, as the plan sponsor, who's basically the main target of this plan, the owner, the main principal of the plan, will be set up with a significant contribution credit. And in most cases, the other employees, unless there's special requests that Don had mentioned, usually the employees have a much more modest contribution credit that just is needed for compliance testing. So that contribution credit, say it's $100,000 per year, that gets earned every year that the participant works 1,000 hours, and that goes forward with interest credit. And that's a guaranteed rate of interest, and that's written into the plan provisions. Generally, we have a fixed rate of interest between 3 and 5%, which is fairly conservative, obviously. And those credits, the contribution credits and the interest credits, accumulate year after year, and basically they accumulate to what we call the hypothetical account balance. We say hypothetical, Don, I think, called it theoretical. A lot of odd names there, but that's basically because, as opposed to a 401k type plan where I can go onto John Hancock and look at what my current balance is based on my investment allocation that I selected, the hypothetical account balance is basically something that Definity, as the TPA, as the actuary, tracks year by year based on the guaranteed rate of interest credit and the contribution credit, which can either be based on a flat dollar amount or a percentage of compensation, depending on how the plan is designed. So of course, if reality played out the way our assumptions did, which does not happen, I can tell you as an actuary, the idea would be the employer would fund a contribution each year equivalent to that contribution credit. The underlying investments, the way that the investments are set up, would grow at 5% or whatever that interest crediting rate is. And at the end of each year, we'd have an apples to apples comparison. The total assets in the plan based on the contributions and investment return would equal the hypothetical account balances, and we could be on our way, and I wouldn't have much need for a job. But obviously there's other circumstances that come up. For example, as I'm showing here, if the markets turn south, like they did in March 2020, a lot of our pension plans saw significant asset losses. And granted, much of that turned around throughout the latter part of 2020. But the point is here, the contribution credits, the hypothetical account balances are guaranteed because it's a defined benefit plan. Losses, as opposed to a 401k plan, losses that are, on the employee themselves are on the hook. In this plan, the benefit is guaranteed, and it's the sponsor that would potentially have to make up any losses, which I'll talk about next. Okay, just real quick, an example of what the language looks like and numerically what it looks like. Here's Dr. White. Her compensation is $200,000 every year, similar to the prior doctor I had at the top. And we've designed the plan, and based on what her goals are for deduction purposes, what she has available, what she expects to, how long she expects to have the plan, we've set up a contribution credit of 80% of her compensation. And the plan's interest crediting rate, a provision in the plan, is set at 5% per year. So that's all written into the plan document. There's an interest crediting rate that's filled in that pre-approved document Don was talking about. And then we have a section where we define the contribution credits for Dr. White and other employees. They can obviously have different contribution credit amounts. So in numerical terms, in this hypothetical situation, we're starting in 2021 with zero balance. Dr. White has nothing when the plan is first effective. As of December 31st, 2021, she gets 5% of zero, which is obviously just zero, and she gets the contribution credit of 80% of her compensation. Moving that 1 year forward, just to see how the pattern continues, she'll then get 5% of her 12/31/2021 balance, plus another contribution credit based on what she earns compensation-wise in 2022. And the hypothetical account balance continues to grow as long as the plan is not terminated, which obviously would cease all that. Or if the plan is amended and maybe starting in 2024, Dr. White says, hey, I want to be a little more aggressive and I want to amend my contribution credit to 100% of compensation. And so that's just basically the accumulation of how the hypothetical account balance grows. So we're interested in actually the cash, like how deposits are formulated and what goes into the plan. So like I said before, if the reality played out like assumption, what the plan sponsor would deposit each year would be equivalent approximately to the contribution credits. And the interest credits that are guaranteed to all the participants, that would be made up by the investment return. But obviously, reality doesn't play out like assumption. In this example here, kind of a different assumption or a different example. In this plan with the employer and then their employees, the total hypothetical balances as of the end of 21 are 400K. And that's just the accumulation of however long the plan's been active, the accumulation of the credits. Based on the prior deposits and the investment returns, the asset value at that time is 300,000. Simple arithmetic. We would do our valuation, and the recommended balance or the recommended contribution we would say for the year is $100,000. And we just we're looking through our actuarial prism. We're very narrow-sighted. When we come to our recommendations, we're just looking at the liability versus the assets, because obviously we want to make sure the benefits that are earned by everybody in the plan, the liability, is fully funded via contributions and investment return. So I have a little note here that just says that if we have consistent demographics, meaning there's not a lot of coming and going, there's not a lot of turnover, employee compensations tend to stay similar year in, year out, it will be fairly predictable to estimate what the annual cost will be on a yearly basis. Because if my contribution credit is 50% of my pay and I have the same pay, I project to have the same pay year in, year out, well, we can pretty much guess what 50% of my pay will be in all future years. So there's generally will be consistent contributions as long as reality plays out like assumption, which I can't say that enough, it obviously doesn't. Well, that's kind of boring. Why do you hire Definity and why does the actuary need to sign the Schedule SB? Well, under the Pension Protection Act, which is about 12 years now, they changed the way the funding calculations work in these defined benefit cash balance plans. And even though we say, how I highlighted here, we say we recommend this amount to fully fund your plan, we're only one piece of the equation. Don had that little exhibit that said, we work obviously with the plan sponsor and we're working with your CPA, we're working with your financial advisor. That may not be the goal for this particular year, is to fund this 100,000. Maybe you had a boost in revenue this year and you have a lot more taxable income than you otherwise would. Well, even though the 100,000 will make the plan assets and liabilities apples to apples, maybe a $200,000 contribution this year is more pragmatic for your situation. Because the Pension Protection Act allowed a range of contributions, this minimum and maximum, generally the minimum will be below the recommended amount and obviously the maximum will be above. Any contribution within that calculated range, which is what Definity is responsible for, anything can be contributed and fully deducted in that year. So that gives a little more flexibility rather than just contributing the same old amount year in and year out. This is another point that Don kind of touched on. We do an annual valuation each year, and we provide this calculated range of the minimum and maximum contribution that you can put in to stay compliant within the IRS requirements. As time goes on, as the plans age a little bit after the first few years, that range tends to open up more and more. And so sometimes we have plans where the recommended contribution is 200,000 and the maximum is somewhere over $1 million. Now that's not necessarily we don't necessarily recommend, obviously, that you would fund that much for reasons I'll get to in a little bit. But over time, the range tends to expand. Certain factors that come into play that would affect the minimum and maximum range when we do our valuation is obviously prior year asset performance. This example has been used a number of times, but if we assume that the assets are going to grow at 5% and they lose 10%, that's a 15% swing. And in general, that investment loss will need to be made up through future contributions that are the onus is on the employer. Additionally, historical contributions. We, in that simple example I was referring to before, the recommended contribution would be 100,000, and taking investment returns out of the equation, if we're shooting for a $1 million lump sum at retirement age, and we sign up a plan sponsor who's 52, and they're going to have 10 years of contributions, they want to get to that million. Again, ignoring investment return, we would say, okay, you can put $100,000 in per year for 10 years, and that'll accumulate. We're going to what I just said a few minutes ago. If there's a significantly successful year and you have more taxable income that you want to put in, perhaps in 2022 you put in 150,000, so which is more than what you ordinarily would and what the plan has laid out for you. And if you put in a little bit more in one year, then maybe the next year you carve off a little bit of what you're used to funding, and it'd be maybe a little less than 100,000. I'm sorry. So basically, the point is, as opposed to a defined contribution plan where you fund one year, it grows, and you don't look back. You're just worried about the current year and the future. Here, in a cash balance plan, everything plays together. What you do in year one, in some way, will directly impact what happens in year 8. So it's definitely a cumulative process that we're looking at. And obviously, as like in a defined contribution plan, you hire new people and they come into the plan and you're covering them. Of course, that'll increase your costs, which would in turn increase the minimum required contribution in that given year. So we're talking about here there's two prongs of setting up one of these plans. The first prong is, why do retirement plans exist? We want to save such that when we stop working down the road, we want to have a sufficient retirement income to support us. Additionally, if you have employees, while I wouldn't call them an afterthought in this case because they are getting benefits, the goal is to mostly benefit the principal owner of the plan and get them a satisfactory retirement. In addition to that, there's also the added bonus of that tax deduction, which is why most of you are probably here today, because in the near term, that's very important. So in that prior example, I'll go to that the recommended amount, the assets versus the liabilities, is 100,000 for that year. However, the maximum, like I said, could be way higher than that recommended amount based on how our back house calculations work out. So the natural kind of begs the question, why wouldn't I just fund the maximum every year? It's within the calculated range. It's fully deductible. What's the catch? Obviously, we want the investments to grow. I'm just going to keep throwing money in as much as I can. But that's not always the goal. So the IRS defines these retirement plan limits that Dave talked about a little bit up top. In the defined contribution plan, they limit what you can put in. So as I said here, the limit in 2021 was 58,000. Obviously, with that example I had earlier with the doctor had the catch up, so it was 64.5. For defined benefit plans, there's obviously limitations to what you can put in, and that's what we calculate each year. But what the IRS defines as their limits when it comes to benefits is what you can take out. Dave had mentioned the annual annuity limit, which is $230,000 per year, which is the most that someone can take out of the plan as an annuity. However, like I said, a lot of these things we look at as a lump sum. One second, please. We look at this as a lump sum, and therefore we want to know how much the assets can grow on a lump sum basis rather than looking at that annual annuity. So based on that $230,000 maximum annuity that Dave was talking about for 2021, if we take the present value of that, the maximum that someone could take out of the plan as a lump sum is about 2.95 million. And there's a lot of different boxes to check. they have to be a certain age, they have to have participated in the plan for a certain number of years, they have to have historical compensation, which many of our principal owners in these plans can check off. Just to point out, if someone is not 62 years old or younger, or they have 5 years in the plan rather than 10, or they don't have the historically significant compensation, in the 200, 300,000, then that 2.95 will be reduced. For purposes of this example, I'll talk about a one-person plan in which the owner checks all those boxes. So we've come to the end of the plan. That hypothetical account balance has grown to 2.95 million based on assorted contribution credits, interest credits. And the IRS says that's the most that person can take out of the plan. Good. I'm good that his plan benefit matches the IRS maximum. Well, historically, the plan sponsor has been putting in the maximum because the plan allows you, the funding rules allow you to overfund the plan on an ongoing basis. So they've been funding the maximum, which is more than the recommended that we talk about each year. And the investments have hit out of the park. Instead of a 5% return, they've returned 15%. And the plan assets at the time they want to terminate the plan are 3 million. Well, Don touched on a little bit when he was talking about the plan termination process. If the one participant in the plan can only take out 2.95 million, but the plan assets are 3 million, what do we do with that extra $50,000? We have to find a home for it, and that's not in the IRA of that one person because they are capped out. So that could cause problems unless there's certain remedies that we come up with. The primary approaches are shown here. The default approach is essentially that $50,000 that can't be paid out to that owner because they're already capped out. It reverts back to the company. There's ordinary business income on that 50,000. That 50,000 is treated as ordinary business income. Plus, they have an excise tax, which just goes straight to the IRS. It's nothing that Definity is handling. Nothing that that we set. It's nothing that we gain from it. So we don't like to have any asset reversions. But that's basically the IRS's way of saying, you put in too much or you invested too well. So this is our way of punishing you for having too much in the plan, more than we say you can have. So a way to avoid this is to either soak up that excess 50,000 if there's any other participants in the plan who aren't already at their limit, like this person in this situation is, they're already at the 2.95. So if you have a spouse that's, their plan benefit is somewhat muted, but their maximum is in the $2 million range, perhaps that person can just absorb that excess $50,000. Alternatively, and this is what we see most commonly, is a transfer of that surplus to a replacement plan, which is a new or existing defined contribution plan. In this case, that $50,000 will be transferred over to this existing or new defined contribution plan into some sort of suspense account. And basically that $50,000 can be used towards future years' employer contributions, such as profit sharing or safe harbor. And as long as that's fully used up, there's no excise tax because there's no surplus anymore because it's fully used up. So that's just the idea is we want to shoot for as high of a account balance or investment account balance as we can, but it's within limitations. It can't just, if we have $1 billion in the plan, that's wonderful, but there are certain limitations of what you can take out. So how do we avoid becoming overfunded? On Don's last note, he noted that early in the life of the plan, it's a little less important. Of course, we always want to be aware of this, but it's more a conversation to have when you're a few years out from terminating the plan and not the day of when I say, oh, I want to terminate my plan, and now we're going to think about this. So one way to avoid having an overfunded status where you have a potential excise tax at the end is to work with your advisor to have a more conservative investment return than maybe you otherwise, a conservative investment allocation than you otherwise would, in a profit sharing plan. I put the contribution in and I want it to grow as much as it can. I want it to return me 100% per year. And a DB plan, that's kind of the one retirement vehicle where you don't necessarily want that, because like I said throughout, we're shooting for a final asset amount for when the plan terminates. In this prior example, we're shooting for that 2.95. How we get there is relatively unimportant. So, the two prongs that I was talking about earlier are the retirement income that we want to establish for when the principal owner is going to hang it up, but we also want to we also want to get the significant tax deductions on the near term. And so if we assume that the plan is going to return 5% and there's actually a 20% return each year, well, that's going to limit the deductions that the plan sponsor could take in future years, because essentially future contributions, future deductions are eaten up by these investment gains. And that's why we, while we don't investment advisors, we don't give investment advice. A more conservative approach is good for both the low end, for when there's a downturn, and also when there's a big boom. It keeps the plan more in control. And obviously, it goes without saying that collaborating with Definity as the third-party administrator, as the actuary, and the CPA to determine the contribution amounts year by year. So we would all work as a tripod along with the investment advisor. The CPA will say, here's what your income is, and as long as it can be supported, we want to put in as much as we can into the plan to get to defer that much taxes. But that's when we come in and we have the conversation that, hey, this is a brand new plan. Yeah, that might be a good idea to go ahead and fund as much as you can, and then we'll worry about it down the road. Or we might say, well, this plan is nearing termination. We might want to limit what we're putting into the plan this year so we don't get into an overfunded situation. So, like I said, ultimately, we're targeting a future goal. The idea is whether the assets that we're shooting for are made up of deposits and returns. How we get there is basically a balance between all parties, and just make sure that we're all on the same page of how we're going to get there. And just real quick, the other side of this is we have an underfunded plan. So obviously we look at these with dollar signs in our eyes, and we want everything to grow, but that's not always the case. And there have been years where the liabilities continue to grow because that's how the defined benefit plan works. But there's been poor asset return, and there's been losses, or these other examples that I already gave about some factors of why costs would increase. So if you find yourself in the underfunded situation in which basically the liabilities that have accrued in the plan are less than the assets, are more than the assets, I'm sorry, because that would be underfunded. There are certain ways that we can go about it. And obviously we would have a conversation with the plan sponsor to make sure that what we're suggesting is doable. Obviously the easy, quote easy solution there would be just, oh, I lost $50,000 in the market in last year in the plan, I'm just going to fund an extra $50,000 next year. It's not as easy as that always. One thing we can do is amend the plan prospectively. We can't do anything about what's happened so far, but we can amend the plan prospectively such that instead of that principal in that example earlier getting 80% of her compensation as a contribution credit each year, maybe starting in 2022, she's only going to take 50% of compensation, which will obviously slow down the costs, which will allow the investments to hopefully catch up to what the liability is. We have one solution called a freeze, and you can either do a hard freeze or a soft freeze. That basically means as of the certain date that we amend the plan to be frozen, either a hard freeze in which no new employees are going to be coming into the plan, and anybody that's already in the plan, their benefits won't continue to grow. That's a hard freeze. Or a soft freeze, basically just does half of that, where the people that are already in the plan as of the date of the freeze, they continue to earn benefits, but any new employees are basically locked out. And there are certain boxes that have to be checked to make sure the freeze will work for your plan. And then finally, when we get to the end of the plan, this is not something that can be done on an ongoing basis, but at the end of the plan, if there is a shortfall, and let's say we have a single owner cash balance plan that their benefit in the plan is accrued to $1 million. And we get to the end of the plan and their plan assets based on the investments and contributions are only $900,000. Well, they have the option as the majority owner to either fund that final $100,000, then quickly turn around and take the $1 million out, or they could forego, which is how it's written in the regulations, or waive down basically, just so your benefit is now $900,000, which is equivalent to what the plan assets say. This is only something that's available when you're terminating the plan. And so if you find yourself in a shortfall situation on an ongoing basis, we would need to look at one of these other techniques. So lastly, just to reiterate everything kind of we've talked about throughout this afternoon, really a successful defined benefit cash balance plan, whatever design you end up choosing, it relies upon the different legs of the stool. And so there's the three different tripod, I'll use that term again, and we're all working with the plan sponsor to make sure that we meet their needs. We as the Definity, as the actuary, we're responsible for designing the plan up front, just based on the goals that are stated at the very outset. And obviously we do the annual administration, recommend the contributions, and figure out, strategy wise, how this is going to work. The CPA is obviously there, and there's probably many CPAs on the call today. You guys are obviously there to help, determine what can be put in. I might say, hey, we recommend you putting in 200,000, but the CPA may say, well, I've reconciled your return for the year and you can only put in 150. And then we could have a conversation about that. And then obviously the financial advisor is responsible for having that conservative growth. And obviously that we would want to fit something that works within the plan's provisions, that will grow, but not at a ridiculous pace. So naturally, we all have overlapping priorities and responsibilities, and it's obviously very important for us to keep that communication open. So I thank you guys for joining this afternoon. If there's any questions that have come in, I don't know through the chat if Leah has any, or if there's anybody who wants to ask any questions now, feel free. Our contact information, I've put it on here, so you can get in touch with Leah, myself, Don, and Dave. And I thank you guys for coming in this afternoon.